Let's welcome in a global market voice. Maximillian Kunkel of UBS Global Wealth Management joins us right now from Zurich to talk about his thoughts on the global markets and what India could do as well. Maximillian, good having you. Thanks so much for joining in. The top talking point in India, of course, is these exit polls and the resultant move that we've seen in the Indian markets. But for the world at large, I reckon US-Iran and US-China trade war are big talking points too. What's the overall stance and where does India fit within there?
So the overall stance continues to be one where ultimately what we have is global growth, which is more durable than originally feared. We have a central bank activity, which continues to be very supportive of equities, and at the same time also underinvested market participants. So that in turn should continue to, over the medium term, support equity markets globally. The problem is, as you just highlighted at the moment, the trade frictions and the uncertainty surrounding that, which also keeps us, for example, less bullish than we would have been under different circumstances. How does India fit into all of this? India has obviously on a strategic position something which continues to favor it as a part of any global asset allocation, which is a fantastic mix of demographics and productivity and urbanization catch-up. Tactically, we also find India at the moment somewhat more interesting after the derating that we've recently seen.
Maximillian, what do you think would be the stance of some of the large money managers whose money you would be managing, for example, investors that is, on India, given that there is political continuity, seems to be political continuity on the basis of the exit polls? Was that a big factor when it came to investors looking to invest in India, direct investors?
Tactically, absolutely. So what we, for example, have seen is that both clients, but also from our perspective, we've been somewhat more cautious on India over the last 12 months, largely due to the risk of ebbing investor flows, but in particular also a less decisive government maturity. What we are starting to see is some of that is already priced in, and particularly with the latest results, we should also see more and more of that trend reversing.
What happens to emerging market currencies now, Maximilian? We've seen the strength coming back into the Indian rupee in today's session, but that obviously being a reaction to the exit poll numbers here. But structurally, what have you made out of what's been happening to emerging market currencies?
So broadly speaking, we think that emerging market currencies at the current juncture should do relatively well. And that's above everything else due to the dollar doing less well than it did in the past. We continue to see the US dollar being in its final innings of this year-long bull run. We see the growth differential between the United States and the rest of the world coming down. We see the Federal Reserve clearly having pivoted. And at the same time, when we're thinking about emerging markets, clearly you see some currencies that are very cheap. And at the same time, with a reduction also potentially in that growth differential between the US and the rest of the world, there should be more of an interest again in some risk-on currencies, particularly in emerging markets.
All right. So what is the broader view now? I mean, if you take a look at from a perspective of a foreign institutional investor, the options are wide open in terms of where there is some interest in moving back into China, ex-emerging markets. Japan is turning out to be a favorable market for foreign money to move into, looking relatively cheap in terms of sectoral valuations as well compared to India. So do you think that foreign money would rather go to these countries than come to India?
Absolutely. So you mentioned already two elements that are of great importance to our clients and also to ourselves recently, which is on the one hand China, which continues to be a structural growth story, which is still not fully reflected in most clients' portfolios. And on the other hand, more tactically, Japan, which, for example, we had recently upgraded in our tactical asset allocation against the Eurozone. What you have here is a market that has significantly derated due to concerns around, on the one hand, global trade, China, and lastly also the local economy. And we think much of this is overdone, so clearly prefer Japan at this juncture.
All right. Just to get a sense from you as to, what is the expectation with regards to the equity market performance, global equity market performance coming in from the US. There have been a few peaks and troughs in the recent past where volatility has kicked in even in the US equity markets. And following that, India has suffered too. Is there a significant risk that one witnesses there within the US equity markets as well with regards to earnings being slightly more unstable this time?
So there is clearly that risk, but what we continue to find is that the underlying fundamentals in the United States, both in terms of the macro as well as the micro, continue to be extraordinarily stable. And we also find that valuations in the US aren't excessive at all. So you put that together with, on the one hand, risk of any recession in the United States, be it with regards to the macro picture or the earnings picture being relatively low, even if you include an escalation in the trade discussions between the US and China. And on the other hand, also still underexposed investors globally to equities that should bode well for the United States. Maybe in a less fervent fashion that we've seen over the last few years, and maybe with more volatility. But overall, we continue to see the equity markets grinding higher from here. That in turn should also benefit emerging markets, and in particular also India.
Okay, Maximillian, we'll leave it at that. Thanks much for taking the time out and speaking to us at Bloomberg Quint India.